Okay, ladies and gentlemen, time for another exciting episode of Stacking Adventures. Today is Monday, January 2nd, 2023. This is Season 7, Episode number 1. And the subject today is the 2022 asset returns. But before we get started, let's just take a look at a couple of these coins that I found. So this just came in change. Here's a 2022 Washington quarter. And if I flip it over, you can see it's got a picture of Wilma Mankiller. This is the American Women series of coins in 2022, the quarters. So she was a Cherokee princess and chief. And then the next one I got here, I got just these, in change. Here's Nina Otawarren, and she was like the first Hispanic woman on a dollar bill, on a U.S. currency. And finally, we got Anna Mae Wong, who was, I think she was a filmmaker or something. So that's the new coins here that we have. Now, in the opening sequence, I just showed you some of these automobiles. So here's like my newest addition to my fleet here. This is a Hummer EV, electric vehicle. The thing weighs about 4,000 pounds. And I just add this. Here's my whole fleet of cars. So now we get started with our presentation. I'll try to get through this pretty quickly. So this is the executive summary, and there's 3 points I want to make. Number one is that we had high inflation in the U.S. for the second year in a row. In 2021, it was 7%, and in 2022, as of November, it was 6.78%. So the prices have gone really high. Anything you buy, like gas, oil, electricity, food, it's all up in price. The second point, the big story, was that the interest rates went way up this year. And that meant bond prices went way down. For instance, the 10-year Treasury went from 1.67 to about 3.87 at the end of the year. So a lot of people are surprised. They had their bond funds and their bonds for safety, and they all went down in price. In fact, some bonds, you'll see when I get through the bond section here, some of them lost as much as stocks. And finally, the third big story was that energy prices went way up. That's really part of the first thing with high inflation. But all the energy prices, like oil and gas, went way up. The electricity bill doubled, mine doubled, my gas bill doubled, and the only place that actually made money this year was U.S. energy stocks. Everything else did terrible. So I just put some numbers on some of these currency numbers. So again, the CPI-U, the consumer prices went from 278 to 297. 278 to 297. That's a 6.78% year-over-year change as of November. And as far as the euro, well, the euro, it started out the year at $1.13 and ended at $1.07, so it lost 5.43%. And the bigger basket of foreign currency, U.S. dollar index, the higher the number is, the stronger the dollar. So it went from 96.67 to 103.49. So basically the dollar was really strong this year. So before I get started showing all the funds, I'll just show you my grading scheme. It's graded from A to F, just like in school. And the way I have it set is if you go up from 20 to 30%, you get an A. 10 to 20%, you get a B. 0 to 10%, you get a C. D is 0 to minus 10%, and F is minus 10 to minus 20%. If it's worse than minus 20%, it's an F minus, and more than 30% up, you get an A plus. Okay, so here we'll actually look at the very top level of assets. So this is world stocks, bonds, gold, and cash. And you can see a lot of red there. I put all the negative returns in red. And the next to last column there shows the total return. So total stocks went down minus 18%. And gold just about broke even and went down about minus 0.47%, about 0.5% down. And the total U.S. bond market was down minus 13%. You can see it's almost as bad as the stock market. And the total international bond market went down minus 12%. Meanwhile, the only thing that made money last year, really, as far as the very top level look, is the money market funds, which started off the year with paying 0% interest. Remember, last year it made like 0%, and this year it made 1.5%. So here's the precious metal prices. Gold, this is a gold, these are all ETFs. So the gold ETFs lost 0.47%. Silver actually went up a little bit, made 2.37%. So a little bit of profit in silver. Platinum made about 10%. Palladium lost about minus 6%. Physical copper looks like it went down 16%. And a really terrible year for the cryptocurrencies. Bitcoin started the year at $47,000 and ended the year around $16,000. It lost 64%. You know, incredible loss if you hold crypto. I gave it a minus triple F. You know, three F minuses. It's so bad. So next we have the world stocks showing U.S. versus international. So the S&P 500 lost 18% last year, which gives it an F grade. And the U.S. total stock market, which is almost the same, lost 19% last year. Now the total international actually beat the U.S. market last year by just a couple of percent. It only went down minus 16%. So we'll move on here to the break down the U.S. stocks a little bit more, the value versus growth and large versus small. So last year, value didn't do that bad. It actually lost only 2%, whereas the growth stocks lost a tremendous amount, minus 33%. And the growth stocks are things like Tesla and Amazon, and they all went way down last year. And if you break down the large cap versus small caps, they both lost minus 19% for large and minus 17% for small. Now, if you break down the international between developed and emerging and Europe and Pacific, they all had negative numbers about the same. They're all down about minus 15 or 16 or 17%. No one really did that great. They did a little better than the U.S. market, but not that great. Now here's the high dividend stocks and the dividend growth stocks for international and U.S. And these actually didn't do too bad in the U.S. The high dividend U.S. Fund only lost 0.44%. You notice it paid 3% income return and minus 3% capital return. So that means the price went down a little bit, but it paid a dividend of about 3%, so it almost broke even, not quite. Meanwhile, the international dividend fund lost about 9%. It paid, where am I looking here? No, not 9%, it lost 6%. It paid a higher dividend in the U.S., 4.3%, but its price went down about 11%. And a lot of people like the dividend appreciation funds. They pay a lower dividend yield, but they have higher dividend growth. But they both lost more than the high dividend stocks. The U.S. dividend appreciation lost minus 9%, and the international dividend appreciation lost 16%. Okay, so here we have the consumer staples versus consumer discretionary and some other sectors. Now, the consumer staples are things like Procter & Gamble, you know, things that make stuff like toilet paper and things that you buy every week no matter what happens. And it only lost about a little less than 2% down. But meanwhile, the consumer discretionary was terrible, lost minus 35%. Consumer discretionary is things like new cars and just things like that that you don't buy very often and you could put off buying it. So that's they get a minus, double F minus. Utilities is one place that actually went up last year, and they went up 1.12%. they paid about 3% dividend yield, but they only lost about 2%, so you basically made about 1%. And I included a couple of others here. The financial sector lost about 12%, just about like everybody else. But the really bad area was what they call communication services, which I think is what they used to call telecoms, and they lost 38%. So a terrible time there in consumer staples and discretionary. Now here's a couple more sectors. Here's the U.S. real estate down 26%, international real estate down 22%. And here's the one place that did pretty good, the energy fund, up 23%. It's the only place that got an A grade in the entire spectrum of assets. And finally, the healthcare fund lost about 1%. So not too bad for healthcare, but the energy fund was the place to go. And as you all probably know, that's because that's where the basically the Western countries, the United States and Western Europe, put all these sanctions on Russia, and they basically drove the energy prices up through the roof. So a terrible year for the people who are buying, like consumers who have to buy gas and oil. But if you own the energy stocks, you did great. Okay, now we're going to turn our attention to the fixed income market. And again, these things actually, interest rates went way up last year. So a lot of the bonds lost money this year. So we'll look here first at treasuries. And going from top to bottom, it goes from the shortest to the longest term. So the Treasury Money Market Fund actually made 1.5%. And again, just like the regular money market fund, it started off the year paying 0%, but now it's paying like 2 or 3%. So for the whole year, you got 1.5% income return. But the longer you went out on the Treasury yield curve, the more money you lost. So the short-term Treasury index lost 4.7%, the intermediate lost 10%, and the long-term lost 29%. So that's really shocked people. People had their money in the intermediate and long-term bonds. Treasury bonds are supposed to be super safe, but they do have, they call interest rate risk. And when interest rates went up, they lost 10 to 30%. So the next one we'll look at here is the STRIPS, tips in the agency funds. STRIPS are zero coupon bonds, and the EDV is the extended duration treasury. This had a tremendous losses, minus 37%, far worse than even the stock market did. And now here's a shock that a lot of people had. The TIPS fund, since inflation was high this year, everybody thought the TIPS fund would go up. Nope, it went down 12%. And that's because the real interest rates went up. So people were sad to see that the inflation came along and all their inflation protections failed. Gold didn't go up, silver didn't really go up, TIPS didn't go up. There was nowhere to hide for inflation protection. And finally, the last one I show here is an agency fund, the Ginnie Mae fund. Those are mortgage-backed securities, and they lost 10%. So we'll just continue on here. The municipal bond funds, these are tax-exempt funds from like cities and states and the state agencies that don't have to pay federal income tax. And again, the further you went on the yield curve, the more money you lost. The top is the money market fund actually made 1%, but then as you go from short to intermediate to long, you lost more money. The short lost 8%, minus 0.8%. The intermediate lost about 7%, and the long term lost 10%. Then you have the high yield tax exempt, which are a slightly lower grade, and they lost about 11 or 12%. And now here's the corporate bonds. Corporate bonds, again, the same principle holds. The further you go on the yield curve, the more you lost. So the short-term corporate lost 5%, the intermediate lost 14%, and the long-term lost 25%. And here's the funny thing. Now we have the junk bond fund called high yield corporate or junk bonds, and that only lost 9%. So it actually lost less than the investment grade bonds. And here we look at some balanced funds, and we put this in there to show you what a combination of stocks and bonds would give you, which is what people usually invest in. The 60-40 balance index lost 16%. That's about average of what a lot of people got last year. A lot of investors lost about 15 or 16%. Target retirement income lost about 12.7%. Then we get these two managed funds from Vanguard. Wellesley Income lost about 9%, and Wellington lost about 14%. The global versions of those lost a little bit less. Again, the U.S. stocks were a little behind the international stocks last year for the first time in many years. Okay, now we move on to the lazy portfolios. The lazy portfolios are the expert recommendations on what to invest in. All these people have published books, and you can read a book by them, but we'll just quickly go over them. The Energy Bias lost 12%. Bill Bernstein Coward's portfolio lost 10%. The Coffee House portfolio lost 14%. The Bogleheads 3 Fund lost 17%. David Swenson's Yale Endowment lost 21%. The DFA Retirement Income lost 9%. Got a few more here. Larry Swedroe lost 11%. Bain Favors Ivy portfolio lost 10%. Scott Burns Couch Potato lost 16%. The Warren Buffett portfolio lost 18%. However, Warren Buffett's company, Berkshire Hathaway, actually went up 1.9%. So his actual investment, he made money last year. And the last one is the Harry Brown portfolio, which is stocks, long-term bonds, gold, and treasury bills, lost 12%. So that was the summary for the asset returns and portfolio returns for 2022. Pretty bad year for everybody. Everybody except the energy funds. And everybody lost money. Their cash lost money, their bonds lost money, their stocks lost money, and even gold lost money. So this awesome, awful year for investors.